Today, on 1st of December, we have taken a class on Introduction to Corporate Taxation. It is for Raiganj University, MBA Semester 3. The problem that we have encountered that in our library there is no book for the assessment year 2026-2027. So that's why we have started with the entire study material of CA Inter. But again the problem has arisen that how to fit our entire course, that is the syllabus of Raiganj University, into 20 hours, which is allotted for the entire course, including internal examination. So for today, what we have done, we have given an introduction. What is taxation? What are the differences between direct taxation and indirect taxation? Why the study of corporate taxation is at all required? What is the proportion of tax revenue collection on the part of the government in between indirect and direct taxes and among different head of income? So we started with the definition of person under section 2 subsection 31 of Indian Income Tax Act 1961, and among different persons which are listed in that particular section, for example, individual, HUF, partnership, and within partnership also partnership firm treated as such, and partnership firm treated as association of persons, etc., etc. We have identified corporate assessing because the name of the title is corporate taxation. Therefore, the entire syllabus become narrow because many of the provisions are there in the Income Tax Act which are not applicable for the corporate SEC at all. Say an entire head of income, for example, income from salary, it is not applicable here because the corporate SEC, although it's a valid legal entity, it cannot have any income from salary, right? Of course, the responsibility of computation of TDS from salary income which are working in a company is there, but still we directly eliminate that particular head income from salary. Now what we have done, from person we have gone to the definition of assessee, and how an assessee is different from a person. An assessee must be a person, but there are three parameters. Either he is accessible to tax, or he is accessible to tax. It does never mean that he is paying tax. Ultimately, it may so happen that he does not pay any tax, but he is accessible. This is number one. Number two, maybe some amount of refund of tax that he has paid extra earlier years is due to him in the previous year. That's a possibility. Or there is a third possibility that he is going to pay any advance tax. So in all these three different circumstances, a people is an assessee, which is defined under section 2, subsection 7. So in our syllabus, it is corporate taxation, and the assessee is corporate assessee. Now we have no way but to tell the five heads of income: salary, house property, profits and gains from business or profession, capital gain, and income from other sources, together with the supporting section. For example, salary, we must read section 15 to 17. For house property, we have to read section 22 to 27. For profits and gains of business or profession is section 28 to 44D. And for capital gain, we have to focus on 45 to 55. For income from other source, we have to cultivate section 56 to 59. I have also mentioned that what are the basic parameters based on which we can treat a particular head under a particular, we may treat a particular income under a particular head. For example, if you want to treat a particular income under the head income from salary, there should be a relationship at the time of payment, employer and employee. The person who pays should be an employer, and the person who receives, he must be an employee. And the reason for which the payment is made during the previous year must be service rendered for which he is or she is appointed. So these are the basic parameters to treat a particular income under the particular head: salary. House property. Because we know previously there was a particular category of head of income, income from interest and securities, section 18 to 21, but that has been eliminated, right? So we skip it and straightway go for income from house property here. Income from house property is under section 22 to 27, and it simply says that the property must be in a habitable state. It does not distinguish between a living house property or a swimming pool or a boxing stadium. So if your property is in a habitable state, there is a possibility that it will attract income from house property. The second condition is this: you, the assessee, must be the owner of the property during the previous year. And third, you must have a rental income from the property, and it's not important for what purpose the property has been let it on hire. It could be let it on hire for business, or you can let your property for residence. That hardly matters. And if you do your own business in your own house property, then definitely that is outside the purview of income from house property. Now I come to profits and gains from business or profession. There are 4 words which are most vital to understand this particular head, that is profit and gain. That is business and profession. All 4 are different terminology and it has different connotation. For example, when we say profit, it obviously implies revenue profit. But in a particular year or previous year, you say that it's not guaranteed that your business will only earn a revenue profit. It may have capital profit also. So what will you do? Will you not tax capital profit? So these are the questions that comes. And what do you mean by business? What is a gain? Gain means an windfall income, which is not a regular income. So that particular, for example, you get a subsidy from the government, or the government gives you a donation for a very particular case, or a grant, then definitely that will be taxed under gain. Now let us distinguish between business and profession. By business we mean trade, commerce, manufacture, or any adventure in the nature of trade, commerce, manufacture. As simple as that. It's easy to know the distinctions between trade, commerce and manufacture. Trade means buy and sell, and the difference is your profit. Commerce means the entire activity. It includes trade and manufacture both. And manufacture concentrates when you buy a raw material and give it in a different shape after value addition. But what is adventure in the nature of trade? I had to tell a story of a military camp. Suddenly a military troop has to evacuate a particular place in the hilly area, and there was hardly any time to sell the properties that they are leaving behind, because there was the scope. So at the last moment, the military sold all the properties living at the hilly area on the 11th hour to a local businessman. The local businessman held the property for a long period, say 8 to 10 years, and after that he sold it. So it has been held that this particular activity on the part of a business who are not habituated in buying tents or ammunitions or utensils, etc., was his adventure. But it was adventure in the nature of trade, because there should be a purpose for any rational being to buy some property. So it was basically taxed under the head profits and gains of business or profession, in the subcategory of adventure in the nature of trade. Now comes capital gain. That's very important. We all have capital asset by some means or others, and we transfer it. If we have 2 house property, definitely in 1 house property we either rent it out or we sell it simply. The people who are very cautious, who are afraid of letting their property on rent, they simply sell it after some years. So in this case, 2 different conditions are satisfied. One is capital asset and the second one is transfer. Both the conditions are satisfied. And the resultant is your capital profit. And this capital profit could be categorized again under two different means. One is long-term capital gain, and the other one is short-term capital gain. And the capital asset also is categorized under two different categories. One is equity share and the other one is any capital asset other than equity share. Holding period is also different to treat, either it is as a short-term capital asset or a long-term capital asset. For equity share, the minimum holding period should be 12 months. So if you hold a particular equity share, say Mazagao dog, for a period of 1 year and then sell it, so it will be treated as long-term capital gain from share, right? And the rate of taxation will be different. Naturally, if you hold Mazagao dog for a period of 11 months or less, say 12 months less than 12 months, so in that case, it will be treated as a short-term capital gain, and definitely the tax rate will be higher, because at that point of time, it will be presumed that you are buying Mazagao dog for speculative purpose. What is the distinction between investment and speculation? That's a different point of debate, but so far as the taxation is concerned, the holding period of 1 year is a must for equity share to treat it either in the category of long-term capital gain or in the category of short-term capital gain. Now I come to other than equity share. Other than equity share category, the holding period is 36 months. So if you hold your capital asset, say as building, for a period of 36 months or more, and if you sell it, then it comes under the category of long-term capital gain. And if you hold the capital asset, maybe a machinery, of course some of the capital assets are exempted for your personal belongings, your coat, jewelry, etc. Not jewelry, but coat, your writing tables, etc. These are not your capital asset. So if you sell your capital asset, say building, for example, and suppose it was purchased for 2 lakhs, maybe in the 1993, and you sell it for 6 lakhs in say 2025. So in that case, there will be a capital gain of 4 lakhs, but it is untrue. What is true? That is, so far as the cost is concerned, 2 lakhs, it is to be indexed. It is to be indexed with reference to the index number, which is called CII, Cost Inflation Index, with reference to 1993 and with reference to 2025. If you find that the index numbers are different, then the indexation should be done properly to compute capital gain. Now the most important question that arises, whenever capital gain arises, is the assessee under compulsion to pay the tax? No. There are several sections for tax exemption. Section 54, 54B, 54D, 54EA, EC, etc. or 54F that clearly state that for different amount of long-term capital gain, there are provisions that if there is a subsequent action, you can save capital gain tax. For example, you sell your house property and even after CII benefit, your capital gain is say 3.5 lakhs. And if you deposit this entire amount of 3.5 lakhs in a capital gain savings bond with say Axis Bank or State Bank or any other bank, there are a lot government schemes. In that case, the entire amount of income tax, entire amount of capital gain tax is exempted. There is another way. Suppose somebody believes that the rate of interest is quite low, 4 to 5% or maybe even 2 to 3%, so I will not go for bond purchase. So what he can do to save the amount of tax? Number one, he can buy a fresh house property within a period of 2 years, or he can construct another house property for a period of 3 years. In that case also there will be a lock-in period. Of course, the entire amount of long-term capital gain will be exempted, but there is a lock-in period of 8 years. Within 8 years, if either the bond which has been purchased from Axis Bank is encashed or the house property which has been newly bought or constructed within the stipulated time period is subsequently sold, then the capital gain tax which has been exempted earlier will be reintroduced. We have not talked about anything about income from other source. Just we have mentioned that if any particular income does not come under the purview of 4 different heads, that is salary, house property, profits and gains, and capital gain, it will automatically be treated as income from other sources. Now let me end my presentation with few words about indirect tax. You know, the collection of indirect tax is quite higher than collection of direct tax. And so far as the indirect tax is concerned, in the this concept of financial year, assessment year, previous year is not true. Only the concept of financial year is true. And only GST, goods and service tax, is applicable nowadays. But from the scrutiny we have found that along with GST, some other indirect taxes are still there. And definitely we will be elaborating on this particular issue next day. I will not be sacrosanct in my presentation on the very first day if I say that this is everything about taxation. No. A part of Indian taxation is very, very closely related to international finance. Let me highlight it on the basis of the syllabus prepared by the Raiganj University, and which is not there in CA Inter. Sorry to say. What are the 3 parts? That is transfer pricing, and international taxation. This is an issue which is a part of international taxation and which has been covered by Raiganj University syllabus and not covered by CA Inter. Maybe it is covered in CA Final, I do not know. This is number 1. Number 2, cross-border mergers and acquisition. If there is a cross-border mergers and acquisition, definitely it has an effect on taxation. So those particular portion will also touch, because that is affected by currency rate fluctuation, because multi-country is involved. Another particular point I must say, double taxation avoidance agreement. Depending on geopolitical issues, there are very good political nexus between different countries, and India is not the exception. So for those countries with which India is having a political relationship, or to say in particular that there are double taxation avoidance agreement, which was previously being called double taxation avoidance treaty. So these issues are the part of international taxation as well as international finance. We will definitely cover up within the allotted time of 20 hours in the next 4 days. What we have planned, that one of our student is outside West Bengal. And for that particular student and for the students community at large all over the India, the entire day, whatever we will be teaching, right or wrong, we will try to make it a brief presentation in video for all 5 days. So today is 1st of December, and this particular video presentation will continue till 5th of December. Please stay tuned with us. Thank you so much. Have a nice time.